Okay, so today we're going to talk a little bit more about monetary policy, and we're going to talk a little bit more about the tools that the Fed uses to control monetary policy, and more importantly, what the impact is of those actions that it takes. Okay, defined here, the monetary policy is the fundamental objective uh, of monetary policy is to assist the economy in achieving a full employment, non-inflationary level of total output. Remember that equates to GDP. Right? And the Fed is able to alter the economy's money supply and stabilize aggregate output, employment, and price level through the alteration of the money supply, hence monetary policy. Right? Monetary policy's goals are increasing the money supply during a recession to stimulate spending, or restricting money supply during inflation to constrain spending. Very similar to fiscal policy, but using money supply as the instrument to make sure that the recession and uh, inflation are in control. Okay. So if we take a look at the balance sheet of the Reserve of the federal banks, you've got securities and you've got loans to commercial banks as assets, right? But the liabilities are reserves of the commercial banks. Remember that the reserves of these commercial banks sit with the Fed. They also have the Treasury deposits from the U.S. Department of Treasury and Federal Reserve notes. That would be a whole bunch of cash. Well, how do they impact monetary policy? What we're going to take a look at first is the open market operations, also known as the OMOs. We've talked about that before, buying securities from commercial banks. Okay, the banks give up the security, the Fed pays the bank money, and the banks have increased reserves. We've talked about that a couple times so far in this unit. Right? One thing we haven't talked about is buying securities from the public. The public gives up securities, and the public then takes that money and puts supposedly a check in the bank, and now the bank has increased reserves. So if you as an individual were to buy securities, right, the Fed would give you money, and they would hope that you in turn, instead of investing it somewhere or instead of spending it somewhere, would actually put that money into the bank, right? And when that money goes into the bank, then the banks have increased reserves. Okay? When the Fed sells securities to commercial banks, the Fed gives up securities and the bank pays the Fed, and then the bank has decreased reserves. Again, we've talked about that before. When the Fed sells securities to the public, the Fed gives up securities, the public writes checks to the Fed, right? Now that that money from the public is gone, banks have decreased reserves. Okay, talk a little bit about bond prices and interest rates. So we'll go back here. Bond prices and the interest rates are inversely related. That's important to write down. Bond prices and interest rates are inversely related. Okay? So when the Fed is, and that'll make more sense here in just a second. When the Fed is buying bonds, the demand for them increases. The price of bonds rise and their interest rates fall. A little obscure to get, but the price of bonds will rise and their interest rates will fall as the demand increases. Lower interest rates will cause the banks and other bondholders to sell them to the Fed. They don't want them. They don't want them because they're not making that much money, so they'll sell them to the Fed. When the Fed is selling bonds, there's an increase in supply of the bonds in the market, and it causes the price of bonds to fall and their interest rates to rise. Okay? Again, it's inversely related. It's kind of an anomaly there. Those higher interest rates will cause the banks and other bondholders to buy them from the Fed, since now bonds are a better investment than, say, a savings account or something like that, right? So that higher interest rate will be like, hey, that's not a bad idea. Let's go ahead and grab some of these bonds. Okay? We've already gone through this whole process. Okay? If the purchase of a $1,000 bond from the bank or from the public creates $800 in excess reserves, what will happen is there will be a $4,000 bank system increase for a total money supply and the increase of $5,000. Okay, if I were to purchase a $1,000 bond from, say, Chase, right, that $1,000 would turn into $5,000. Okay, the reserve ratio. We've already done this before, but it's worth reviewing. Raising the reserve ratio, the banks must hold more reserves. The banks will then decrease lending, and money supply will decrease. This is another tool of the Fed if they want to contract money supply. All right, lowering the reserve ratio, we've done this before. Banks may hold less reserves, banks increase lending, and therefore the money supply increases. The discount rate. This is the rate that the Feds charge the bank for overnight lending. Remember, at the end of the day, the Fed requires, the federal government requires the banks have a certain amount of money on hand, hence the reserve requirement. A lot of times banks don't have that because they'll loan out more than they take in. Well, they're going to have to borrow money from the Fed on the overnight, right? And the rate in which they borrow that money from the Fed is known as the discount rate, okay? If you raise the discount rate, banks are going to borrow less from the Fed because, well, they're going to decrease lending. They're going to make sure that they have enough money on the books so it doesn't cost them a lot of money on the overnight, right? And then money supply will then decrease. Okay, if you lower the discount rate, banks are going to buy more money from the Fed, borrow more money from the Fed, therefore increase lending, and money supply then increases. Okay. Talk a little bit about easy money supply and tight money supply now. Go ahead and transition through that. Easy money supply, the goal is cheap, available credit, and increasing the money supply. Go ahead and take a second and jot these down. This is a good graph to know for easy money supply, a good chart to know. Go ahead and hit pause and jot this down. This is a good chart to write down. We'll walk through it here in just a second. The Fed will buy government bonds from the banks or the public, okay? Or the Fed will lower the legal reserve ratio, or the Fed will lower the discount rate, okay? Those are actions of easy money supply. What's going to happen? Well, there will be an increase in banks' excess reserves, and banks can make more loans. When banks can make more loans, they're going to loan that money out. All right? When the Fed lowers the legal reserve ratio, there'll be an increase in money supply. All right? And if there's an increase in the money supply, there'll be a lower interest rate, which will cause investment to increase and GDP to rise. When the Fed lowers the discount rate to charge members' banks, the amount of change, sorry about the spacing there, that will happen will depend on what's called the size of the income multiplier. We've done that already. Okay. And we'll talk more about the discount rate in class tomorrow because it's kind of a difficult concept to get. Right? But it depends on how much money the banks actually loan out versus how much money comes in. Right? And the income multiplier here is if people aren't making a lot of money, right, there's not a lot of money coming in, so the banks may need to borrow more. We'll talk more about that in class. Tight money policy. The goal here is to restrict credit and decrease the money supply. Again, we want to make sure, go ahead and jot this down. Go ahead and hit pause and jot this down if you need to. Essentially the same actions that we went through. The Fed will sell government bonds and banks to the public. Okay, it'll decrease the bank's excess reserves, and the bank will issue fewer loans. The Fed will raise the legal reserve ratio. Again, it'll raise the interest rate, or a decrease in the money supply, and will raise the interest rate. Okay. And the Fed will raise the discount rate charged to their member banks, and again, that's comes down to the multiplier. All right, now if you take a look, it looks like these two could be interchanged. Decrease in the money supply, right, can be also, of course, tied to the Fed selling the government bonds. And yeah, that's true, right? The ultimate result is there's just a decrease in excess reserves and an increase in the interest rate. That is important to note here too. These are interchangeable. More so worried about the actions right now, be more so concerned about the actions than the results. Because the results obviously is a decrease in the money supply. Okay. You hear a lot, and your book explains a lot about the transition mechanism for monetary policy, real GDP, and price level. All right. The money supply impacts the interest rates. This is how it works. It's kind of a multi-step process here. The money supply impacts the interest rates. Interest rates affect investment and some consumer spending. We talked about this in class the other day. Right? C&I are a component of aggregate demand, okay, and equilibrium GDP and price level are changed. If if interest rates affect investment and I goes down, AD is going to shift to the left. If interest rates affect investment and interest rates go down and I goes up, then AD will increase. Okay, just some graphs here. If the money supply increases to stimulate the economy, you've got money supply moving to the right. Interest rates decrease from 10% to 8%. Okay, quantity of investment demanded goes up. Right. If I goes up, then GDP increases with a little bit of inflation. Okay, again, increasing the money supply, continuing to draw down that interest rate. We also have to watch for price level. Okay, because price level will start going up a little bit more. And basically, this is the same thing for tight money supply, but just reversed. You've got everything shifting. You've got interest rates going up, money supply shifting left or increasing, and therefore AD is also shifting left. Some strengths of monetary policy: speed and flexibility. It's real easy to do, and it's real quick. Not a lot of political pressure, because the Fed isn't a political body. And a lot of times, most people don't get what's going on at the Fed. But it's important to note that monetary policy doesn't take an act of Congress or an act of president or anything like that. There's no political pressure there whatsoever, right? And then the federal funds rate, again, on the overnight, loaning each other, loaning money between banks, loaning money from the Fed, is just, that's basically what's going on. People are saying, are the Feds going to raise the rates? Are they going to lower the rates, right? They don't really care about money supply. They don't really care about open market operations or anything like that. It's always, what did the Fed do? Did they cut rates or lower rates or anything like that? That's only a small component of it. In recent monetary policy around here is we've lowered our interest rates to next to nothing. The federal funds rate is next to nothing, trying to stimulate the economy, and it doesn't seem to be working. Okay, problems and complications. Electronic banking makes it tougher to control the flow of funds, right? The change in velocity, if people start holding money now, that's going to complicate things as well, all right? And what's called cyclical asymmetry. You don't have to worry too much about that term, okay, but it's easy, just understand that it's easy to get results with a tighter monetary policy. Okay. In the international world, we learned that fiscal policy may be weakened, okay? With monetary policy, in Chapter 11, we learned that fiscal policy may be weakened in terms of exports and imports. So with monetary policy, though, the net export effects works to strengthen monetary policy actions. Exchange rate changes which will occur in response to interest rate changes act to increase that effect. Let me show you here what I'm talking about. Go ahead and jot this chart down. It's pretty simple to get. Okay, easy monetary policy, decrease in foreign demand for dollars because the dollar depreciates. Net exports increase because our goods are cheaper. Aggregate demand increases because people are importing more stuff. Tight monetary policy means that there's an increased demand for foreign dollars. The dollar appreciates. Net exports decrease and aggregate demand therefore decreases. Again, we'll walk through this in class tomorrow, but this is worth pausing and jotting down right here. Last slide. Monetary policy could also work in aid in reducing trade deficits, okay, because an easy monetary policy causes net exports to increase and moves trade balances closer to equality, right? But a tight monetary policy with higher interest rates causes net exports to decrease, and this will push the trade deficit higher. And so, easy money policy alleviates trade deficit, but aggravates the trade surplus. But tight money policy or monetary policy aggravates a trade deficit, but alleviates a trade surplus. Again, we'll talk more about these things. If you've got questions, jot them down in your notes, and we'll talk a little bit about the situations that we just ran through just now, and we'll do some sample problems to give you some chances to move these things around and understand it in terms of graphing, not just in terms of writing it down from notes. That is all.